Here's the hook most people miss. Japan isn't reacting late. It's reacting strategically. After battling deflation for generations, the country is finally seeing sustained wage growth and price increases. That gives policymakers the confidence to normalize rates, but it also forces a global reset. Trillions of dollars have been positioned around Japan's low-cost money. As rates rise, those positions must be unwound. And that means volatility, capital movement, and tighter financial conditions everywhere. This change doesn't stay inside Japan's borders. Higher Japanese yields attract money back home, pulling liquidity out of overseas markets. That pressure shows up in weaker currencies, falling asset prices, and higher borrowing costs across the globe. Banks reassess risk, corporations rethink expansion, investors reprice entire portfolios. One policy shift in Tokyo suddenly becomes a mortgage issue in London, a bomb problem in New York, and a growth challenge in emerging economies. But here's the deeper message beneath the headlines. The world is leaving behind the age of free money. The safety net that supported markets for years is being rolled up, and moments like this separate those who react emotionally from those who move strategically. This is where awareness becomes power, because when a financial giant like Japan changes direction, it's not chaos, it's transformation in motion. Those who understand the shift early don't panic. They prepare, they adapt, and they position themselves for what comes next. The reaction was immediate, almost electric. Within hours of Japan's policy shift, global markets began to move, and not quietly. Stock indexes wobbled, bond yields jumped, currencies swung, and investors rushed to reassess positions built over years of cheap money. This wasn't a slow adjustment. This was a shockwave, and it carried one clear message. The world was not prepared for Japan to change the rules. Here's the hook most people overlook. Markets don't respond to headlines, they respond to expectations. Japan's move forced investors to rewrite their outlook in real time. Traders who had relied on yen-funded strategies suddenly faced higher costs. Global funds began shifting allocations. Risk assets felt pressure as money moved towards safer ground. This is how uncertainty shows up, not as panic at first, but as volatility, rapid repositioning, and a growing sense that something fundamental has changed. The bond market spoke loudest. Yields surged as investors priced in tighter conditions, signaling that borrowing is about to become more expensive worldwide. Equity markets followed with sharp swings. Reflecting fears of slower growth and reduced liquidity, currency markets added another layer, with the yen strengthening as capital flowed back into Japan, putting strain on emerging economies that depend on foreign investment. Every asset class felt it because every asset class had been supported by the same underlying force, easy money. But this isn't just a story for traders on Wall Street. This movement reaches far beyond financial screens. When markets turn volatile, businesses delay expansion, governments face rising debt costs. Consumers encounter higher loan rates. Retirement portfolios feel pressure. The chain reaction spreads quickly, touching everyday lives in ways most people never connect to, decisions made in distant central banks. Here's another hook. Volatility is not random. It's the market's way of discovering a new balance. For years, global investors operated in a world where liquidity was abundant and risk felt manageable. That environment is changing. Now, every earnings report, every inflation print, every central bank statement carries more weight. Confidence becomes fragile. Timing becomes critical, and discipline becomes priceless. What we are witnessing is a global repricing of reality. Markets are recalibrating to a future where money has a cost again. That process is messy, uncomfortable, and unpredictable, but it's also revealing. It exposes weak strategies and rewards careful planning. It punishes complacency and elevates preparation. In moments like these, the difference between reacting and responding becomes everything. Because while markets may shake, informed individuals recognize that turbulence isn't just risk, it's also a signal that a new economic chapter is actively being written. Borrowing costs don't rise quietly, they ripple through every layer of the economy, and that's exactly what's beginning to happen. Japan's shift away from ultra-loose monetary policy is already pushing global interest rates upward, and the effects are moving faster than many expected. Here's the hook. When one of the world's biggest lenders tightens financial conditions, money becomes more expensive everywhere. From home buyers to corporations to entire governments, the price of borrowing is being recalculated in real time. For years, Japan provided a steady stream of low-cost capital that helped keep global rates suppressed. Banks, hedge funds, and multinational companies relied on this flow to finance expansion, refinance debt, and chase higher returns abroad. Now that foundation is changing. As Japanese yields rise, investors demand higher returns elsewhere too. That pressure travels directly into mortgage rates, business loans, and sovereign debt markets across continents. Suddenly, what once felt affordable becomes a heavier financial burden. Think about what that means on the ground. Families face higher monthly payments when refinancing homes. Small businesses hesitate before taking out new loans. Corporations rethink hiring plans and delay major investments. To governments, already carrying historic levels of debt, confront ballooning interest expenses that crowd out spending on infrastructure, healthcare, and education. This isn't abstract economics, it's a tightening grip on growth. Here's another hook most people miss. Rising borrowing costs don't just slow economies, they reshape priorities. Companies shift from expansion to efficiency. Consumers move from spending to saving. Investors pivot from risk to stability. The entire financial ecosystem begins operating with caution. That transition alone can cool demand, soften labor markets, and amplify uncertainty. Even before any official recession signals appear, emerging markets feel the pressure first. As global rates rise, capital flows back toward developed economies offering safer returns, currencies weaken, imports become more expensive, and central banks are forced to raise rates defensively, even when growth is fragile. Meanwhile, highly leveraged sectors, real estate, technology, and speculative investments become vulnerable as refinancing grows harder and profit margins shrink. But this moment also carries a deeper message. The age of effortless borrowing is fading. For more than a decade, cheap credit masked inefficiencies and rewarded leverage. Now, discipline matters again. Balance sheets are being scrutinized. Cash flow is king. Financial resilience becomes a competitive advantage. And here's the final hook. Higher borrowing costs don't simply test markets, they test mindsets. Those who adapt early learn to manage debt wisely, preserve liquidity, and invest with intention. Those who cling to yesterday's conditions struggle to keep pace. Because when money tightens, strategy matters more than ever, and preparation becomes the most valuable asset in a world where capital suddenly comes at her. A price? When uncertainty rises, instinct takes over. And right now, that instinct is driving investors towards safety. Across global markets, capital is quietly but decisively shifting away from high-risk assets and into traditional safe havens. Government bonds, gold, and stable currencies are seeing renewed interest as portfolios are reshuffled for protection rather than growth. Here's the hook. This isn't fear-driven chaos, it's calculated repositioning. Investors are preparing for a world where liquidity tightens and volatility becomes the new normal. For years, easy money encouraged risk-taking. Capital flowed freely into speculative stocks, emerging markets, and high-yield opportunities, all supported by cheap borrowing and abundant liquidity. Japan's policy shift disrupts that balance. As rates rise and financial conditions tighten, investors reassess exposure, riskier assets suddenly look less attractive while stability gains value. This transition is subtle at first, but powerful in impact, reshaping entire asset classes. You can see it in market behavior. Equity rallies fade quickly, high-growth stocks struggle to hold momentum, emerging market currencies come under pressure as foreign funds retreat. At the same time, demand increases for government securities and defensive investments. Portfolio managers shorten time horizons, hedge more aggressively, and prioritize capital preservation. The focus moves from chasing returns to managing downside. Here's another hook most people overlook. This shift doesn't just affect markets, it changes corporate strategy. As investors become more selective, companies with strong balance sheets and predictable cash flow attract attention. While highly leveraged firms face tougher scrutiny, access to funding tightens, valuations compress. Businesses that once thrived on easy capital must now prove real profitability and operational strength. The movement towards safer assets also exposes vulnerabilities in emerging economies. Many rely heavily on foreign investment to support growth. When global capital pulls back, currencies weaken, inflation pressures rise, and central banks are forced to respond with higher rates of their own. That creates a difficult cycle. Borrowing becomes more expensive just as economic momentum slows. But beneath all of this is a larger transformation taking place. Investors are relearning the value of patience, diversification, and discipline. The era of effortless gains is giving way to one where risk must be carefully measured and every decision carries weight. This is what a financial reset looks like in real time. Quiet reallocations, strategic withdrawals, and a growing emphasis on resilience. And here's the powerful truth behind the headlines. Money always moves before narratives catch up. By the time the broader public feels the impact, institutional capital has already adjusted. This rotation towards safety is not a temporary reaction. It's a signal that the global investment landscape is evolving. Those who recognize this early don't chase markets. They position thoughtfully, to protect their capital and adapt to a world where stability becomes just as valuable as growth. A major economic reset may be unfolding, and the signs are impossible to ignore. Japan's sudden pivot away from decades of ultra-loose monetary policy is more than a local adjustment. It's a spark that could ignite a global recalibration. Here's the hook. When one of the world's largest economies changes direction, it forces every other economy to take notice. Countries, corporations, and investors who have relied on years of easy liquidity must now rethink assumptions, adjust strategies, and prepare for a financial landscape that rewards discipline over complacency. The ripple effects are already visible. Supply chains, capital flows, and trade dynamics are all sensitive to shifts in interest rates and currency strength. As borrowing costs rise, spending slows, and investment decisions are postponed, creating a feedback loop that challenges growth expectations. Economies that have become accustomed to cheap money and abundant capital suddenly face a reality where every decision carries more weight. Investors and policymakers alike are confronted with a sobering question: how do we navigate a world where financial cushions are being removed almost overnight? Here's another hook. Resets like this are rarely gradual. Markets are not linear, and financial systems are interconnected. The unwinding of decades-long stimulus can amplify vulnerabilities that had been hidden beneath layers of cheap credit. Highly leveraged firms, overextended governments, and emerging markets dependent on foreign investment become particularly exposed. Volatility is no longer a temporary side effect. It is a signal of the system recalibrating, redistributing risk, and redefining what constitutes sustainable growth. This is also a moment of clarity. A reset like this forces institutions and individuals alike to scrutinize their assumptions, reconsider long-term plans, and confront inefficiencies that were previously masked by easy money. Corporations rethink expansion strategies, governments reconsider fiscal priorities, and investors reassess the true cost of capital. Every sector of the global economy is being tested, and survival depends on awareness, adaptability, and proactive decision-making. The deeper hook lies in perspective. While headlines emphasize fear and instability, economic resets are also the birthplace of opportunity. They reward foresight, strategic thinking, and disciplined execution. Those who react impulsively get swept up in volatility, but those who recognize the reset for what it is, a recalibration of value, risk, and potential, can position themselves advantageously. History has shown that periods of global economic adjustment often precede the rise of a new generation of winners who are prepared to navigate the changed landscape, harness its possibilities, and thrive where others struggle. Individuals and businesses around the world are being reminded that preparation is no longer optional, it is essential. Japan's decisive shift in monetary policy is sending clear signals that financial conditions are tightening, and the ripple effects reach far beyond the nation's borders. Here's the hook. When one of the world's largest economies changes course, it forces everyone to reassess their strategies. Households, corporations, and governments alike are being challenged to evaluate their financial resilience, manage risk more actively, and make choices with long-term stability in mind. For individuals, the implications are immediate and tangible. Rising borrowing costs affect mortgages, credit cards, and personal loans. Volatile markets challenge retirement portfolios and investment plans. Inflationary pressures can alter purchasing power overnight. Those who have relied on passive financial habits or assumed that low-interest conditions would persist are now facing a reality check. The hook lies in opportunity. By proactively reviewing budgets, reducing unnecessary debt, and prioritizing savings, individuals can turn uncertainty into a platform for greater financial control and confidence. Businesses feel the effects even more acutely. Companies that expanded aggressively under conditions of easy credit now face high supply chains may be disrupted as costs rise and liquidity contracts. The companies that survive and thrive will be those that act strategically, preserve cash flow, streamline operations, and focus on sustainable growth rather than short-term gains. Here's another hook. This period of recalibration favors foresight and discipline. Firms that anticipate challenges and build adaptability into their operations will emerge stronger, while those that ignore the signals risk being left behind. The broader lesson extends to the global economy as a whole. Governments, particularly in emerging markets, must navigate rising interest rates, capital outflows, and increased debt servicing costs. Institutions that fail to act decisively face pressure on both domestic growth and international credibility. Conversely, those that strengthen fiscal discipline and encourage sustainable investment are better positioned to weather turbulence and capture opportunities as conditions evolve. Perhaps the most important hook is that preparation is not reactive, it is proactive. Those who monitor financial trends, understand risk exposure, and take deliberate steps to protect and grow their resources. Gain a strategic advantage. Volatility is inevitable, but vulnerability is optional. By acting before circumstances force decisions, individuals and businesses can navigate uncertainty with clarity, confidence, and control, turning what could be a period of disruption into a stage for opportunity, growth, and long-term resilience. So as headlines scream, crisis and uncertainty fills the air, remember this: you are not powerless, you are adaptable, you are capable, and you are living in a moment that will define a generation. Japan may have flipped a switch, but you control your response.